Hello friends, last week in my video, I told you that the upthrust still remains in the realms of an technical pullback or a technical rebound rather than a complete trend reversal. Well, the bulls tightened their grip on the market even further. In this week's video, I want to examine whether the rally is sustainable, how sticky is it, and what will it take for the bulls to sustain their momentum. So let's dive right in, and on your screen now is the market roundup window, which tells you that it was the banking space which led the upthrust because the bank nifty clearly rose twice as much in percentage terms as the Nifty 50 did. A weak US dollar index, which almost fell a full 100 basis points, triggered an upthrust in emerging markets, including India. Commodity prices went up, barring gold, which saw a technical correction, and this is all thanks to the sell off on Friday. Oil and gas also rose. The USD INR, which is the United States dollar versus the rupee, also fell 8 basis points, which means the rupee strengthened against the dollar. This was another reason why our markets were strong. The 10-year benchmark bond yield went up by 1 basis point, which means bond prices came down very, very slightly. NSE gained market capitalization for a month in a row, and the MWPL continued its upward march. The US indices provided tailwinds to the Indian markets by rising yet again. Now coming to our in-house indicators, let's take a look at the MWPL. Now, this is clearly a proxy for risk appetite prevalent in the markets because MWPL stands for market-wide position limits. This is the extent of exposure utilized by traders as compared to the total exposure allowed by SEBI. Now, in the second week after expiry of the March derivative series, we are at 27.45%. Let's take a look at what the commensurate levels were after the second week of expiry in February, January, and December. What you find is that we are at the lowest in the last 4 series in comparison. So risk appetite is definitely somewhat curtailed. It's not down significantly, but the fact remains that guys are not writing out big enough checks. This is a very small concern. Let's go to the next indicator, which is the turnover. Now, this is a turnover of all 4 trading sessions compared to the previous week's 3 trading sessions because the prior week was, of course, even shorter. Turnover seems to have risen marginally because there was one more day to trade, and both the indices and individual stock futures turnover rose, with stock futures witnessing a higher percentage. Let's now come to the advanced decline ratio, which after the price is the most sensitive and leading indicator of which way the trends are going. As compared to last week's 1.67 reading, the reading has come down slightly to 1.10, which means for every 100 falling shares, there were 110 rising shares, whereas in the prior week, there were 167 rising shares. So intraday traders, one Marshmallow traders, were a little less gung-ho as compared to the week prior. A very small minor red flag. I now come to the basis, which is the premium enjoyed by the futures vis-a-vis the spot. The Bank Nifty basis has come down sharply to less than half. Do remember the Bank Nifty led the rally, and the basis falling more tells me that 2 Marshmallow traders prefer to book profits at higher levels. And the Nifty basis actually rose, which tells me that short covering occurred at lower levels, which cushioned the decline and pushed the Nifty higher. I have been writing on my social media accounts that I do see short covering providing cushions to downsides, and as long as that happens and the basis remains positive, bulls still have hope out there. Let's now go for the impetus, our in-house exclusive indicator you won't find anywhere on the internet. The Nifty impetus has risen significantly as compared to the Bank Nifty impetus, which tells me that the rally in the Nifty was much more forceful as compared to the Bank Nifty. Now, this divergence is not exactly very great or conducive for a sustainable rally. I would ideally have wanted price and impetus of both the indices to have risen. Anyway, this is something we can put on hold for watch. Not a red flag yet, but definitely something that we need to keep an eye on. Let's now come to another exclusive in-house indicator, the LWTD, which you've been trusting for more than a year now. Although the index has almost flatlined in its weekly gains, the LWTD has slipped a bit to 0.02. Although it's still above zero, the positive reading is negligible, which tells me that fresh buying support on declines may be relatively muted. Short covering is another kettle of fish altogether. Short covering may cushion declines, but it takes fresh buying to trigger a sustainable up move. So the bulls need to try a whole lot harder, and we'll see further as to what the weight of evidence provides us with. Friends, the in-house indicators done, I now come to the bond market, which forms the crux of our cost of funds hypothesis. I told you that the RBI governor has paused rate hikes, even though it's not a complete full stop, it's still subject to data. And even though if rate hikes don't come in and actually rates are cut, we still have a backup plan by way of gilt funds. And I have written exclusive detailed editorials on our free Telegram channel, which I would urge you to join. Last week, what we are seeing is the Indian 10-year benchmark bond yield actually go up by 1 basis point on the weekly chart on your screen. What we do need to see is whether the rates at the street level start to ease or not. How do we find out? NBFCs like Bajaj Finserv, Bajaj Finance, Mahindra Finance, and others, are they cutting rates? Are they offering lower coupon rates on their fixed deposits and non-convertible debentures? Then you could jump into gilt funds where you would get capital appreciation by way of NAV rising and distribution of interest by way of regular payouts, which could possibly give you up to double-digit returns. So don't worry, we are still digging the earth for data, and the search for the best gilt funds is still on. I promise to update you as and when the time is right. Friends, I now come to the Bank Nifty, which led the rally from the front and rose 2.66% as the daily chart on your screen tells you. The index rose on 3 out of 4 trading sessions. It even broke out above the previous significant high of 41,840. Now that is an early sign of the bulls showing intent of pushing the markets higher. Now the first thing I would want if the rally is to sustain is that the Bank Nifty trade or at least close sustainably above the 41,840 levels in the coming week. The month-long moving average has started turning upwards. That is a positive sign. So the bulls are showing signs of strength. Let's turn to the weekly chart where we saw a third bullish candle in a row. The price is above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook has also turned positive. All in all, it looks like the Bank Nifty is in better shape as compared to the Nifty 50. Friends, in the week before last, this index was at number 2 on our most volatile counters list based on statistical beta. It remained at number 2 last week, and therefore the challenge level for the retail investor remains unchanged because higher the volatility, more difficult it is to maneuver through the market. Last week, I advocated a range between 42,500 on the upside and 39,600 on the downside, which held perfectly well. In the coming week, I expect a range between 43,575 on the upside and 40,675 on the downside. So as long as the bulls keep the bank nifty above 41,840, you can expect higher levels. I now come to the Nifty 50, which brought up the rally from the rear by rising 1.30%, rose on all 4 out of 5 trading sessions. As you can see on the daily chart on your screen, it's broken out with a gap above the solid red trend line, which marked the peaks after the October 2021 tops. The price is above its month-long moving average, which is a positive. But unlike the Bank Nifty, it is not above a big hurdle, which is 18,115. Although it's crossed the previous swing high of 17,800 made on 6th March 2023. Now, if the bulls were intent on pushing the markets higher, I want the Nifty to stay sustainably and close above the 17,800 in the coming week for it to tell me, hey, I want to go up further. And if it starts closing above 18,115, I think the overhead supply or selling from panic-struck traders who are trapped at higher levels, that overhead supply would have been absorbed. The weekly chart, just like the Bank Nifty, you are seeing that the Nifty has logged gains for the 3rd week in a row, and the price is above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook has improved, but follow-up buying is needed. Friends, in the week before last, this index was at number 9 on our statistical beta of most volatile counters list. It rose up 2 notches to 7th place last week. So volatility actually rose. Last week, I advocated a range between 18,075 on the upside and 17,125 on the downside, which held perfectly well. In the coming week, I anticipate an estimated range between 18,275 on the upside and 17,375 on the downside. Now, friends, I come to the last bit of statistical studies of retail risk appetite by way of percentage contribution of the volume. Remember, this is not an absolute number, this is percentage. That tells me the quality of buying last week. As you can see, the daily chart of a 20-day look-back period, stock options turnover indicated by the sky blue line is marginally higher. That means riskier bets were undertaken. Stock futures line, which is indicated as an olive green or an army green line, was more or less constant with a marginal tilt upwards. Index futures turnover, which is indicated as a red trend line, is sideways. It's not fallen. And the next chart, which tells me that the index options turnover was actually marginally lower. So the safest instrument, which is the index options, saw a lower turnover, and the riskiest instrument, stock futures and stock options, saw higher turnover, which means risk appetite was back. So traders are taking a greater degree of risk, which is a positive, and if this follows through, chances are the market can go up higher. Friends, I now come to what I would do in the week ahead. I expect technology stocks to be a little under pressure, and therefore theta decay would be a good strategy via the options route to get ROI or return on investment. I would allow the interest rate sensitives a little more leeway to rally before I start pursuing my long-standing strategy of theta decay. In commodities, last week I told you I expect a divergence between crude oil and natural gas, with crude leading the way up and natural gas being a laggard. That happened, and that might continue to happen. do see how the producers are trying to choke supply by output cuts that the OPEC Plus has announced. Russian President Vladimir Putin has vowed he would make up for the lost oil export revenue by raising prices and or curtailing supplies. So this is his way of talking the markets up, and that could just work for a while for now. Now, fat tail risk hedge that I talked about in the USD INR is something that I've still not initiated, for the simple reason that the Dixie or the US dollar index is still showing weakness. So why hurry when it is not yet warranted? And I've still not initiated entry into gilt funds because, like I mentioned in the bond segment, I would want conclusive weight of evidence that rates have started coming down before deploying money there. And I'll share the names of the gilt funds as and when the situation is right to do so. Friends, I now come to the most popular segment of this video for statistically minded viewers of mine, wherein I give you 5 stocks which have gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks which have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves on Monday. This is for scalpers. The list is valid only for Monday. Tuesday through Friday, please connect on my free Telegram channel. This is the only place where I put up this list. So the impetus gainers list is led by AU Bank. No surprises, big gainer on Friday. Naveen Fluorine, India Mart, Divi's Lab, Godrej Properties. Impetus losers list is led by Gujarat Gas, Voltas, Indian Oil Corporation, Godrej Consumer Products, and IRCTC. Friends, I hope my videos are making a difference and adding value to your understanding of the markets and making you a better trader. I would love to hear from my online family by way of your comments. Please keep them coming and help me reach out to smart traders like yourselves by sharing my video with your online friends and family. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.